All right, folks, welcome to today's lecture on market structures. This is a fundamental topic for your CFA Level 1 prep, and understanding these concepts is crucial because they form the backbone of many economic principles. We're going to break this down into sections to make sure you grasp every bit of it. Let's kick things off by talking about demand. When we discuss demand, we're looking at how the price of a product influences the quantity demanded. This is where elasticity comes in. Here are the key types of elasticity you need to know. Ready? Let's go. Own price elasticity of demand measures how sensitive the quantity demanded is to a change in the price of the product itself. This measures how much the quantity demanded of a product responds to a change in the price of that product. Imagine you're running a sale at a store and you notice that a small drop in prices leads to a huge increase in sales. That's elastic demand. On the flip side, if your price change barely affects sales, that's inelastic demand. Imagine you love buying coffee. If the price of your favorite coffee brand goes up, you might buy less of it. The own price elasticity of demand is a way to measure just how much less you'll buy. Cross-price elasticity of demand measures how the quantity demanded of one good responds to a change in the price of another good. Think about it this way. If the price of coffee goes up and more people start buying tea instead, tea and coffee are substitutes. But if the price of printers goes up and people buy fewer ink cartridges, those two are complements. Income elasticity of demand measures how the demand for a product changes as consumer income changes. If you get a raise at work, you might decide to buy more luxury items like high-end coffee or dine out more often. Income elasticity tells us how your purchasing habits shift with changes in income. On the supply side, we have concepts like labor supply, labor product, labor cost, and income. The supply side of a market is characterized by important relationships between inputs, outputs, costs, and revenues for a firm. Concepts like total, average, and marginal product of labor describe how much output is produced with different levels of labor input, with marginal product being the additional output from one more unit of labor. On the cost side, total, variable, and marginal cost capture the firm's expenses, with marginal cost being the cost of producing one more unit. Similarly, total and marginal revenue represent the firm's total income and additional income from selling one more unit. These supply-side concepts form the foundation for understanding how firms make production and pricing decisions to maximize profits, as they illuminate the trade-offs involved and the factors that ultimately determine the firm's supply curve in the market. Now, let's understand the basics of different market structures. Market structures are classified based on the number of sellers, product differentiation, and barriers to entry. Economists classify market structures into 4 types, each with distinct characteristics. Ready? Let's explore the 4 main types. First is perfect competition. This is characterized by many sellers, homogeneous products, very low entry barriers, no pricing power. Firms in perfect competition are price takers, meaning they must accept the market price. Examples include agricultural markets where products like wheat or corn are indistinguishable between producers. No single vendor can influence the price, and customers can easily switch from one vendor to another if the price changes. Second is monopolistic competition. Its features include many sellers, differentiated products, low entry barriers, some pricing power. Firms compete on product differentiation through advertising and branding. Examples include restaurants, clothing brands, and hair salons. Third is oligopoly. Oligopoly is characterized by few sellers, homogeneous or differentiated products, high entry barriers, some pricing power. Firms are interdependent and often consider rivals' actions when setting prices. The airline industry is a classic example, where a few major airlines dominate the market and closely watch each other's pricing and service offerings. Other examples include the automobile industry and telecommunications. Fourth is monopoly. One seller, unique product, very high entry barriers, considerable pricing power. The monopolist can set prices as it wishes but must consider the demand curve. Utility companies, like those providing water or electricity, often operate as monopolies in certain regions because it's not practical to have multiple providers. The structure of a market is shaped by several key factors. These include the number and size of businesses operating in the market, with more firms creating a more competitive environment. The level of product differentiation also plays a role, as unique products give companies more control over pricing. Additionally, barriers to entry and exit, such as high startup costs or regulations, can limit competition. Another factor is a firm's pricing power, which refers to its ability to set prices higher than the minimum cost required to produce a product. Finally, non-price competition, like advertising and branding, is a way for firms to influence consumer choice without directly changing prices. These concepts help us calculate break-even and shutdown points and understand how firms make pricing and output decisions. Got that? Great. Let's move on to profit maximization section above. Okay, now let's dive into profit maximization and how it works under different market conditions. In perfect competition, the firm is a price taker with a perfectly elastic demand curve. This means the firm can sell any quantity at the market price, but cannot influence the market price. Total revenue is equal to price times quantity. The demand curve is horizontal, reflecting the fact that the firm can sell as much as it wants at the prevailing market price. In a perfectly competitive market, a firm maximizes profit by producing where its marginal cost equals the market price. This is because in perfect competition, firms are price takers and can sell as much as they want at the market price. So the firm maximizes profit where price equals marginal cost, and marginal cost is rising. At this point, the cost of producing an additional unit is exactly covered by the revenue from selling that unit. In imperfect competition, like monopoly, price is a function of quantity. Initially, lowering the price can increase total revenue, but beyond a point, further price reductions lower revenue. In a monopoly, the firm faces a downward sloping demand curve, meaning it must lower the price to sell more units, which affects total revenue. In monopoly, the firm maximizes profit where MC equals marginal revenue. The monopolist adjusts production to the point where the cost of producing an additional unit equals the additional revenue from selling that unit. Understanding the break-even and shutdown points is crucial for analyzing firm behavior in different market structures. Let's delve deeper into these concepts with detailed explanations and examples. The break-even point is where total revenue equals total cost, resulting in zero economic profit. At this point, the firm is covering all its costs, including opportunity costs, but is not making any additional profit. It's where P is equal to average total cost. For instance, if your bakery's total cost for producing 100 cakes are $500, and you sell those 100 cakes for $500, you're at the break-even point. You're not making a profit, but you're not losing money either. The break-even point is critical for businesses because it represents the minimum level of output and sales needed to avoid losses. Businesses often use break-even analysis to determine the feasibility of new products, set sales targets, and make pricing decisions. The shutdown point occurs when a firm's revenue is not enough to cover its variable costs. If the price falls below average variable cost, the firm should shut down in the short run. For example, if the price of cakes drops so low that it doesn't even cover the cost of flour, eggs, and sugar, it's better to stop production temporarily. In the long run, if the total revenue is not sufficient to cover both variable and fixed costs, the firm will exit the market. This is because in the long run, all costs are variable, and the firm cannot sustain losses indefinitely. Imagine a small bakery facing a sudden drop in demand due to a new competitor. If the price of cakes falls below the bakery's average variable cost, it should shut down temporarily to minimize losses. However, if the bakery expects the market conditions to improve, it might continue operating despite the losses, hoping to recover in the future. Moving on to economies and diseconomies of scale. Understanding economies and diseconomies of scale is crucial for analyzing long-term cost structures and competitive strategies. Economies of scale occur when increasing production lowers the average cost per unit. This can result from factors such as bulk purchasing of inputs, more efficient use of production technology, and specialization of labor. For example, a large bakery can buy ingredients in bulk at a discount, reducing the average cost per cake. Economies of scale provide a competitive advantage to larger firms because they can produce goods at a lower cost per unit compared to smaller firms. This advantage allows them to price their products more competitively or earn higher profit margins. Diseconomies of scale happen when increasing production raises the average cost per unit, often due to inefficiencies that arise from managing a larger organization. These inefficiencies can include difficulties in communication, coordination problems, and increased complexity. If your bakery grows too large, coordinating between multiple locations might become difficult, leading to higher costs per cake. Diseconomies of scale can erode the benefits of growth and expansion, making it crucial for firms to find the optimal size that balances economies and diseconomies of scale. The firm benefits from economies of scale up to a certain output level, beyond which diseconomies of scale set in. It's essential to find the balance to maximize efficiency and profitability. For example, a small bakery might benefit from economies of scale by purchasing ingredients in bulk, reducing the cost per unit. However, if it grows too large and faces coordination and management issues, it might experience diseconomies of scale, increasing the cost per unit. In the tech industry, companies like Google and Amazon benefit significantly from economies of scale due to their massive scale of operations and efficient use of technology and data. However, even these giants need to be mindful of potential diseconomies of scale as they continue to grow and diversify. In the short run, at least one factor of production is fixed, such as the size of the factory or the amount of machinery. In the long run, all factors of production are variable, allowing firms to adjust their operations fully. The long-run average cost curve is an envelope of short-run average cost curves, showing the lowest cost at which a firm can produce any given level of output. In the short run, your bakery might be limited by the size of its kitchen and the number of ovens it has. You can only increase production up to a certain point without expanding the kitchen or adding more ovens. This constraint means that in the short run, you might experience increasing marginal costs as you try to produce more cakes with the same equipment. In the long run, you can expand your kitchen, buy more ovens, or even open new locations. This flexibility allows you to achieve economies of scale, reducing your average cost per cake. However, if your business grows too large, you might encounter diseconomies of scale, where the added complexity and coordination issues increase your costs. To illustrate these concepts further, let's look at a few examples. First, consider the case for short-run adjustment. Imagine a small bakery that experiences a sudden increase in demand during the holiday season. To meet the increased demand, the bakery hires temporary workers and extends working hours. These short-run adjustments allow the bakery to increase production without expanding its physical space. However, the bakery might face higher marginal costs due to overtime pay and the inefficiencies of temporary workers. Now, let's explore the case of long-run adjustment. Suppose the same bakery decides to expand its operations permanently due to sustained high demand. In the long run, the bakery can invest in a larger kitchen, purchase more ovens, and hire additional full-time staff. These long-run adjustments enable the bakery to achieve economies of scale, reducing its average cost per cake and improving profitability. And lastly, let's examine the situation of diseconomies of scale. Now, imagine the bakery grows into a large chain with multiple locations across the country. As the business expands, it faces challenges in maintaining consistent quality, managing a large workforce, and coordinating activities across different regions. These challenges lead to increased costs per cake, illustrating diseconomies of scale. Since we have already discussed the basics of different market structures, let's delve deeper into each market structure and understand their characteristics, profit maximizing strategies, and how firms operate within them. In a perfectly competitive market, several distinct characteristics define its structure and operation. Firstly, there are many sellers and buyers within the market. This abundance ensures that no single seller or buyer has the power to influence the market price. Instead, the market price is determined by the collective forces of supply and demand, with each firm acting as a price taker that must accept the prevailing market price for its product. Secondly, the products offered by different sellers are homogeneous, meaning that they are identical in nature. There is no product differentiation, and consumers have no preference for one seller's product over another's, as all products are perceived to be the same. Thirdly, there is free entry and exit within the market. This means there are no significant barriers preventing new firms from entering the market if they identify a profit-making opportunity, nor are there obstacles stopping existing firms from leaving the market if they find themselves unable to cover their costs. Lastly, perfect information is a crucial feature of a perfectly competitive market. Both buyers and sellers possess all necessary information regarding prices and products. There are no hidden details or secretive practices, ensuring that everyone in the market is fully informed, which facilitates fair and transparent trading. In such a market, firms are price takers, meaning they accept the market price as given. To maximize profit, a firm will produce where its marginal cost equals the market price. In the short run, a firm might earn positive economic profit, but in the long run, the entry of new firms will drive economic profit to zero. Imagine a wheat farmer in a perfectly competitive market. The farmer produces wheat and sells it at the market price. If the price of wheat rises, more farmers will enter the market, increasing supply and driving the price back down. Conversely, if the price falls, some farmers will exit the market, reducing supply and driving the price back up. In contrast to perfect competition, a monopoly is a market structure where a single firm dominates the entire market. This structure is characterized by several key features. Firstly, there is a single seller that controls the market. This firm has no close competitors offering similar products or services, which grants it significant market power. Secondly, the product offered by the monopolist is unique, with no close substitutes available. Consumers who want this product have no alternative but to purchase it from the monopolist, which further reinforces the firm's market power. Thirdly, there are high barriers to entry in a monopolistic market. These barriers can take various forms, such as legal restrictions, substantial capital requirements, control of essential resources, and strong brand loyalty. These factors prevent other firms from entering the market easily. Lastly, a monopolist acts as a price maker. Unlike firms in competitive markets that must accept market prices, a monopolist has the ability to set its own prices to maximize profits, given its control over the market. In a monopoly, the firm maximizes profit by producing where its marginal revenue equals its marginal cost. Due to the lack of competition, the firm can earn positive economic profit in the long run. However, monopolies are often regulated by governments to prevent abuse of market power. Think of a local utility company providing electricity. The company is the only provider in the region, and it sets prices based on its costs and desired profit margins. Because it faces no competition, it can maintain high prices and earn substantial profits. However, regulatory agencies often oversee such monopolies to ensure they do not exploit their market power by charging excessively high prices or providing poor service. Let's move on to monopolistic competition and see how it operates. Monopolistic competition is characterized by many firms offering differentiated products. Key features include many sellers and buyers. There are many firms competing for customers. Each firm has a small market share, and no single firm can dominate the market. Product differentiation. Each firm offers a product that is slightly different from those of other firms. These differences can be in terms of quality, features, branding, or customer service. Free entry and exit. Firms can easily enter or leave the market. This ensures that firms cannot earn long-term economic profits, as new entrants will compete away any excess profits. Some control over price. Due to product differentiation, firms have some control over their pricing. They can charge a higher price if they offer a superior product or a unique customer experience. Firms in monopolistic competition face a downward sloping demand curve, meaning they must lower their prices to sell more units. To maximize profit, a firm will produce where its marginal revenue equals its marginal cost. In the short run, profit is maximized where MR equals MC. Short-run economic profits encourage new firms to enter the market, increasing competition and driving down profits. On the other hand, in the long run, entry and exit drive economic profit to zero. Firms produce where price equals average total cost, but not at the minimum average total cost, leading to excess capacity and inefficiency compared to perfect competition. So in the short run, firms can earn positive economic profit. But in the long run, the entry of new firms will drive economic profit to zero. Firms in monopolistic competition use advertising and other non-price strategies to differentiate their products. They face a downward sloping demand curve due to product differentiation. For example, restaurants in a city exhibit monopolistic competition. Each restaurant offers slightly different food, ambience, and service, attracting different customer preferences. In the short run, a popular restaurant might earn economic profits, but in the long run, new entrants will reduce these profits. Another example is clothing brands. These businesses also show monopolistic competition. Brands differentiate themselves through design, quality, and marketing. Successful brands can charge higher prices, but competition ensures that profits are moderated over time. All right, now let's tackle oligopoly, another crucial market structure. An oligopoly is a market structure with a small number of large firms dominating the market. Key characteristics include few sellers. A small number of firms control the majority of the market. These firms are aware of each other's actions and decisions, leading to interdependence. Just a few firms have significant control over the market, influencing prices and production levels. Each firm closely monitors the actions of its competitors, anticipating their moves and adjusting its strategies accordingly. Interdependence. Firms are highly aware of each other's actions and decisions. The decisions of one firm can significantly impact the others, leading to strategic behavior and potential collusion. Barriers to entry. High barriers prevent new firms from entering the market easily. These barriers can include high capital requirements, economies of scale, and strong brand loyalty. Non-price competition. Firms often compete through advertising, product differentiation, and other strategies. Price competition can lead to destructive price wars, so firms often focus on non-price factors to attract customers. In an oligopoly, firms' pricing and output decisions are interdependent. They may collude to set prices and output, acting like a monopoly, or they may compete aggressively. Various models, such as Cournot and Stackelberg, help predict firm behavior in an oligopoly. In an oligopoly, firms' pricing and output decisions are interdependent. They may collude to set prices and output, acting like a monopoly, or they may compete aggressively. Firms may collude to set prices and output levels, maximizing joint profits. Collusion can be formal, like OPEC, where firms implicitly understand not to compete aggressively on price. Various models, such as Cournot and Stackelberg, help predict firm behavior in an oligopoly. These models explain how firms compete based on output and pricing decisions, either simultaneously or sequentially. In Cournot model, firms choose their output levels simultaneously, assuming their rivals' output levels remain constant. Each firm decides how much to produce based on the output levels of other firms, leading to a stable equilibrium. In Stackelberg model, one firm sets its output level first, and the other firms follow. The firm that moves first, known as the leader, has a strategic advantage and can influence the market outcome to its benefit. Kinked demand curve states that prices tend to be rigid because firms match price decreases but not increases. This model suggests that firms will follow competitors' price cuts but not price increases, leading to stable prices. Consider the airline industry, where a few major airlines dominate the market. These airlines closely monitor each other's pricing and service offerings. If one airline reduces its fares, others may follow to remain competitive, leading to a potential price war. Alternatively, airlines might collude, either explicitly or implicitly, to maintain higher prices and avoid destructive competition. Strategic alliances and code-sharing agreements also illustrate collusion-like behavior. The technology sector, particularly in hardware like smartphones, also demonstrates oligopolistic behavior. A few key players dominate the market, with significant barriers to entry due to high R&D costs and established brand loyalty. Let's talk about Nash equilibrium. It is a key concept in game theory that's super relevant in understanding firm behavior in oligopolies. In simple terms, Nash equilibrium occurs when firms in a market, either each trying to maximize their own profit, choose their best strategy given the strategies that all other firms have chosen. No firm can increase its profit by changing its own strategy unilaterally. They are all doing the best they can, considering what their competitors are doing. Imagine two competing firms in a market. Each firm decides on its pricing and production levels based on what it believes the other will do. In Nash equilibrium, both firms have chosen strategies such that neither can benefit by changing its own strategy while the other firm's strategy remains unchanged. This results in a stable outcome where each firm's strategy is optimal given the other firm's strategy. This concept is important because it helps explain why firms might not always compete aggressively on prices. If lowering prices leads to a price war where all firms are worse off, firms might tacitly agree to maintain higher prices. Nash equilibrium provides a framework for understanding these strategic decisions, illustrating how interdependent actions lead to stable but not necessarily cooperative market outcomes. Finally, let's talk about determining market structure and how we measure it. Let's talk about market power. Understanding market power is crucial for analyzing how firms influence prices and maintain their competitive advantage, which is critical for understanding market structures and firm behavior. Let's dive into the two primary methods for estimating market power: elasticity analysis and cross-sectional regression analysis. One way to measure market power is by estimating the elasticity of demand and supply in a market. Elasticity measures how much the quantity demanded or supplied responds to changes in price. Here's the deal. When demand is highly elastic, it suggests that the market is close to perfect competition. This means consumers are very responsive to price changes, and firms have little to no power to influence prices. On the other hand, when demand is inelastic, it indicates that firms may possess significant market power, meaning they can influence prices without losing many customers. Conversely, when demand is inelastic, consumers are less responsive to price changes. This indicates that firms may have market power, allowing them to set higher prices without significantly reducing their sales. However, this method comes with a few limitations. First, there's the endogeneity problem. This means that the equilibrium price and output are jointly determined by the interaction of demand and supply, making it tricky to separate their effects. To tackle this, we need a model with two separate equations, one for the quantity demanded and one for the quantity supplied. Second, computing elasticity through regression analysis requires a large number of observations, which might not always be available. Lastly, regression analysis relies on historical data, which doesn't always predict future trends accurately. Another method to estimate market power is through cross-sectional regression analysis. Unlike time series analysis, which looks at data over time, cross-sectional analysis examines sales from different firms in the market during the same year or from many buyers and companies in a single transaction. While this can provide insights into market power, it also has its limitations. It's a complex method requiring careful consideration of various factors. Additionally, different specifications of explanatory variables can provide different estimates. For example, using total GDP instead of per capita GDP as a proxy for income will yield different results. Both methods have their advantages and limitations. Elasticity analysis provides insights based on the responsiveness of demand and supply, while cross-sectional regression analysis allows for a snapshot of market power within a specific period. Concentration ratios measure the market share of the largest firms. A high concentration ratio indicates a concentrated market, while a low concentration ratio suggests a competitive market. In the soft drink industry, a high concentration ratio indicates that a few firms like Coca-Cola and Pepsi dominate the market. Herfindahl-Hirschman Index, HHI, measures market concentration by summing the squares of market shares of the largest firms. A higher HHI indicates greater market power. In the wireless telecom industry, a high HHI reflects the dominance of a few major carriers, indicating potential market power and reduced competition. Understanding market structures and their implications helps analysts and policymakers design better strategies and regulations to promote competition and protect consumers. It also enables firms to make informed strategic decisions to optimize their market position. All right, that's a wrap for today's lecture on market structures. We've covered a lot of ground from demand and supply concepts to different types of market structures and their characteristics. Understanding these principles is crucial, not only for your CFA exams, but also for real-world economic and financial analysis. Remember, practice makes perfect. Go through the examples and questions in the CFA curriculum to solidify your understanding. Keep studying hard, and you'll ace this section of the exam. Keep pushing forward.